gang. Welcome back again. This is Monday, or Market Talk Monday, if I could get the words out right.
Mm-hmm.
Isaiah, how was your weekend?
It was good. How about you?
Not bad. Can't complain. We celebrated Elizabeth's 25th rotation around the sun.
Mm-hmm. You old.
So ye old Lizzie. Happy birthday to Lizzie. So this is weekly commentary from the week of the 3rd of August forward. And this is October. You looked at me with big eyes like, August, what are you talking about? We just got out of a client meeting, so I am tired.
Yep.
But we're grinding through to Talk Market, Talk Monday. And a lot of what you're going to share with us is kind of like broken record, right?
Yeah. I mean, again, here we are again. Market reaches all-time highs.
Here we go saying it again.
Yep.
It's kind of scary to keep saying this.
Yep. S&P closed on Friday above 6,700 total value. NASDAQ closed at 1.3%. Dow was up 1.1%, which I think it closed down today. I think the Dow closed down today, if I'm not mistaken. Like we said, we just got out of a client meeting, so I didn't have the chance to look at it. But, yeah, NASDAQ, S&P, and healthcare and tech predominantly driving market returns.
NASDAQ was almost up 71 basis point, or 0.71%.
Yep.
What it closed up. The Dow closed down 0.14 today.
Well, yeah, that drives closer to job reports, and that has a little bit more volatility due to that. What's inside the Dow Industrial, NASDAQ and S&P. Again, last week we saw it close off with highs from the healthcare sector, specifically Pfizer agreed to lower drug prices, and then we also saw tech again driving. That's like a broken record. Tech again. So driving most of the returns, and even in an extended government shutdown, the consumer kind of fought through that. The government shutdown didn't really play an effect on the market, and it increased likelihood of rate cuts in October and December. And I think that mixed with the private sector data were really driving forward overall market returns. So it's been crazy past couple weeks. It's interesting if you read the commentary in there. Levitt did talk about the risk appetite and the risk tolerance of the consumer going up because they saw more people investing in tech again, which is a volatile sector, as well as commodities and cryptocurrency as well. We saw, Bitcoin peaked at $125,000 last week per coin.
Wow.
That's pretty nuts. Beginning of 2025, I remember it being at like 87,000, and now it's at 125.
So those folks out there who are asking for Bitcoin, what's the thoughts? What's the advice?
Ooh,
big picture.
I think Bitcoin has a place in every single portfolio on a small scale. It's a good commodity.
I concur with that.
It's a good commodity. Like I treat it like a commodity. It's really what it is.
So you're saying like gold, silver? Yeah,
having a small percentage of the portfolio.
Yeah.
And I call it the fun side.
Yeah.
Because you can literally see a 5% pullback like that real quick, or you could see it jump at the same pace. So it really is a small percentage of the portfolio of what it should be in, just as a hedge against other asset classes.
Yeah. It's an asset class that I think we have to think of it in the realms of like any other precious
metal
or commodity that we're going to see a lot of volatility in it, I think, in the future. But because we don't know where, commodity prices are headed in the future, I think the consensus is, and what you're saying is, like, make it part of your portfolio, 3 to 10%. It should never be more than that.
Yeah, 10% on that end. That's getting into
super aggressive.
Yeah, that's getting into my speculative investors that they can tolerate that kind of volatility in the portfolio. For my retirees, I would be at 1 to 2 to 3%.
Yeah,
not very much, and it's very hard. Bitcoin's one of those asset classes that's hard as an investment advisor to trade. Because it involves having other things like MetaMask wallets and all sorts of different cold storage, whatever the crypto world is leaning into now. But it's definitely one of those asset classes that's not as easy as typing in the Schwab going Bitcoin.
Yeah.
or typing in S&P 500 ETFs, it's not as easy to grab unless
because it is decentralized.
Mm-hmm.
It's decentralized away from those traditional custodians, the Charles Schwabs,
Yeah,
the Fidelities, the Vanguards of the world, right?
It's really hard for those brokers to get a hold of it and
Yeah.
be able to trade it.
Yeah.
So that it is tough for them. Not saying Schwab definitely has it on their balance sheet. I'm 100% sure of that.
Yeah, for sure.
But openly trading it as any other exchange traded fund or equity, no, it's not. It's not going to be like that.
So long term,
Mm-hmm.
it again comes back to the big D word, right? Diversification.
Mm-hmm. Absolutely.
You can't have too much of a good thing. There can't be too much Bitcoin, too much gold,
Yep.
too much Palantir, too much Google, whatever your flavor of the day is.
The flavor right now could be gold that added $100 to its record. So it's trading. Last week it closed record high again, 3,900 an ounce.
Nice. Mm-hmm. Well, my lucky purchases last year of gold have paid dividends. So
yeah,
my timing of upping my commodity component to my overall plan, which again, it should not represent more than traditional financial planning, represent more than 3% of your overall portfolio.
Yeah. Mm-hmm.
And that's the same thing you're saying with Bitcoin too, right?
Yeah, absolutely. And to people out there that want to have a little bit more, I keep saying this word speculative risk, or they want to speculate more in this cryptocurrency world, you can have exposure to it pretty easily through ETFs. There's a Bitcoin ETF out there that I've been using in our client accounts that gives a little bit of that exposure, just on a smaller scale.
So Isaiah, when we're talking to pre-retirees and retirees,
mm-hmm.
and they've got a 10-year window before they retire, or they're 10 years into retirement, how does this come into play? What should they be doing? What changes should they be making in their portfolio? Is it going back, looking at rebalancing now? So if their growth portfolio has made up more of their retirement income phase,
mm-hmm.
should it be a rebalance to maybe more protected income or to cash? What are you thinking?
Yeah, it plays a part in rebalancing. Me and our funds and me and my team, we rebalance most of our models quarterly. But when it comes to retirees and pre-retirees specifically, it's also what I like to call asset location, where your assets held. And that sounds like a broken record, but really looking at, all right, especially your age in that 10-year window. If you retired at 62, you're about 11 years away from your first RMD. So if you're in your IRAs and you're hitting major returns and you're pretty risky investor, and you're seeing big returns from the tech sector really blowing up, it really comes down to me as asset location. Where is your assets held? And having correlated and non-correlated
mm-hmm.
assets. So correlated meaning anything that's remotely close to the market. So you can have for an example, we have the SPY ETF that mirrors exactly the performance of the S&P 500. So that's a correlation. You can call that or a beta is what we like to call it in the industry. So it has a beta of 1, perfectly tracks it. But being able to have things that are non-correlated as well, so things that aren't reacting to stock market returns. So that's where I'm heading with most of our clients, because we want you to have that risk exposure of the market, but also be able to withstand if we saw the lost decade again, or if we saw 2007 to 2009 where the market gave back about 50.
Especially if you're in the income phase and you're taking distributions from this portfolio.
Because it's super important. The first 3 years of taking income out during your retirement distribution phase have lasting effects on making it the rest of the 25, 30 plus years.
Yeah. Especially
with people living longer now. It definitely, looking at that 10-year tranche, that first 10 years is the most pivotal. If you see over 2007, 2009, if you saw a 52% correction, like we did then, and you're 100% in the markets, and that's where you're getting your income from, well, you just took a 52% pay cut.
Right.
And that has a lasting effect, because now you have to wait for it to get back to even. So at 52%, you need about 100+% return to get back to even.
Year one.
And that's where
how realistic is that?
Yep, not very. And that's where we talk about with most of our clients too, is this 10-year window that you're looking at. You have the first 3 years, like I said, are super pivotal. And when you're going down this retirement distribution phase, it is looking at I like this slide that we do in our workshop, where it shows how long it takes to get back to even. So if you lost, if you had $100,000 portfolio, you lost 50%, and you had so you're down 50,000, it would take about 23 years to get back to even at a 3% return. So that's where you have to have kind of like the coach, and that's the role of the investment advisor representative, of splitting up assets to make sure that some of your assets are exposed to that 3%. On a little bit of a safer route, but not selling and reducing risk so quickly that it's detrimental to your overall portfolio. And that's why you have to have what we like to call actuarial science mixed with investments.
Yeah. You need both.
Yeah, absolutely. So when you have these big corrections in the market, you can be able to withstand that storm and be exposed to asset classes that give you 10 plus % rate of return. So you're not sitting there for the next 25 years you have in your retirement at 3%, and it took you 23 years to get back to even at 3%.
Yeah.
So that's all. That said, selling and reducing risk is not always the answer. It's to make sure that you've already had buckets of money segregated away from market volatility and having some still left in there exposed to risk. So it takes a bit of planning.
So when this market commentary goes out to the advisory clients and to the folks that are creating these income plans where securities is being used with actuarial science or the insurance products that create the income, what we're really saying then is that you need a plan. You need to have a plan to live a long time and for your money not to outlive
you,
or you to outlive
your money. You want your money to outlive you.
Yeah. You want more left over at the end than you have. And that's the idea here, is that when we're exposing that risk to equities risk, and the equities risk is the acceptance of all risk, the insurance side of it is
the transfer
of that risk. So you need a balance of both. And having that can assure a longevity to your plan, or the money lasting longer than you do. That's what you want to ideally have happen.
And it's definitely in our role as playing I like to look at it like a seesaw. You have a balancing act of, okay, I have this safe money over here, my non-correlated assets or my actuarial science dollars over here, and then I have my investment over here, and this risk is kind of playing a seesaw pattern on it. And then also inside of that, then it comes into the tax status of each different account, because taxes are also, you have the tax erosion on your wealth, then you have the market volatility on top of that, and then you have the hidden tax being inflation. So if you're in too much of a good thing on the safe side, you're not hedging against inflation, your dollars are going to be weakened over time. And then if you have too much money over here, you could lose 53%.
So all of that to say is that when we're doing these weekly market commentaries, you're going to always hear us come back to look at the big picture, the small picture, specifically the equities portion. This is the exciting portion. You get to see the real great returns in the portfolio. This is the exciting portion of your retirement planning. But we have to balance that with making the income last. Income is the outcome. So if you want to hear more, if you want to know more, tune in for market commentary on Mondays. This is going out to you. But those of you who'd like to share this with friends or family, please click or smash the like button, hit that subscribe button, and stay in contact with us. We'll be adding more value, more content for you to review over time. And if you'd like to look at more of the longer form podcasts, go over to KP's Black Box or our Kenneth Porter and Company YouTube page. And you guys can put that in the link here, right, Cody? Cody's back in the control room. There he is. So we'll put links to those and maybe some of the longer form episodes that talks more about the retirement buckets and the overall retirement plan. Hey, thank you guys. Isaiah, we good to go? Is that it for today?
Yeah, that's it.
Awesome. Thanks for sharing market commentary with us.
We'll
see you next Monday. Until then, love you guys. Take care.